Good evening, ladies and gentlemen, and thank you for being with me this evening. It's good morning to those in Queensland, good afternoon to the rest of the Great Southland, and good afternoon as well to those across the ditch in the Shaky Isles. So we'll see how we go. All right, so much to talk about. Rising tides was really a reference to what's been happening in the commodity index. Commodities are going gangbusters, and those of you who've been trading for a long time will know that commodities are very sensitive to interest rates. So they're front running the idea that interest rates are on the rise, and much else is still to happen. Let's move on. We've got a whole lot to talk about today. Markets are rational, orderly, and sometimes predictable. And I want to just talk a fair bit today about commodities, but I'm not going to ignore equities. I know everyone's vast majority of you trade equities and you're interested in what's happening there. And of course, interest rates with our analysis of the T-bond market. So commodities, the most popular measure of commodities now is the GSCI, the Goldman Sachs Commodity Index. And it's a benchmark. It's actually made up of 14 different indices. It's a weighted index, and it has 5 major components: energy, industrial metals, precious metals, agriculture, and livestock. And we cover examples of pretty well all of those markets except livestock, and there's a reason for that, which we'll come to as we go along. But most folks who come to me to learn Danielcode trading start with a particular bias. Everyone wants to trade gold and the S&P. Both of them are good trading markets, but no better than that. They're not fantastic trading markets. And the reason for that is that they get so much comment on them. You can't go a day in a financial website, newspaper, what have you, without some comment on the S&Ps and also on gold. But what I want to show you today is that there are many worthwhile alternatives that you may not have considered. And if you think about your trading, margin is the cost of doing business. And as your bank is limited, margin becomes a function in determining turnover, a vital input to your annual profitability. If you've got a fixed bank and a universal profit factor, which is pretty much across the Danielcode as a general statement, the number of times that your bank can be rolled over determines your gross profit. So have you ever thought about marking the average true range, daily range, as a percentage of margin? And the probability is that you haven't, so I've done it for you. And what we're looking at here, I've just listed the success futures in this particular spreadsheet, but you should be doing this for any markets you're trading. If they're not up here, you should do the same thing. And all you Forex traders, most important, you should be doing the same thing as well. There's a lot to learn. Now, this looks like a whole lot of mumbo-jumbo, but what it rolls down to is that the column on the left, that's the markets: oil, US dollar index, S&P, gold, coffee, natural gas, Russell 2000, soybeans, sugar, US T-bonds, and wheat. And what I've done is I've taken a 59-day average true range. That's the average true range on a daily basis, but I've taken it over a period of 59 days so that it levels out lots of those little movements you get. And once you've got that, you can multiply it by the tick value, and you get a dollar value, which is your daily ATR, average true range. So this is the dollar value of what each of these markets move on an average daily basis. And they range over a very wide range here, because we've got some markets in here like sugar that are quite small, and the US dollar index is another small market with low margin. And we've got some giants in here, gold and the S&P. And if you have a look across now, once we've done that, I've just listed in here the latest margin for all of these markets. And what I've done then is I've expressed the average true range, the daily average true range, as a percentage of margin. So the greater that figure is, the more efficient it is as a market for you. And you can see that the Russell comes out way on top. I've been arguing for a while that you should, if you want to trade equities, you're better off trading the Russell than you are the S&P, which the return on margin there is dismal compared to the Russell, for example, which is 48%. So essentially 2.5 days of average price movement in the Russell covers your margin, whereas in the S&P, you're at 3.5 days to cover your margin, assuming that you get them straight up end to end, which you don't. But it gets a very good indicator, this, if you have a look at it. The Russell is the most efficient market of this group of markets to trade, followed by wheat, then followed by natural gas, and then followed by soybeans. And none of this should surprise you. Oil obviously is right up there, but you have a look at those markets, 1, 2, 3, 4, and 5, and interestingly, T-bonds, which is actually a good market to trade, but it doesn't work out so well on these numbers, does it? Because it's got a margin of 3,800, and its average daily range is only $1,400. But look at these three I've marked ICE: US dollar index, coffee, which is a superb trading market, and sugar. Now, they're the three markets here that are on. They're not on the CME. They're on the ICE exchange, the Intercontinental Exchange. And as you can see, they are so bad. All of them, 23% for the US dollar index, 24% for coffee, and 31% for sugar. But it makes it obvious that the methodology that ICE is using to create its margins is different to the methodology being conducted by the CME. So as attractive as they are, think about it, because you're better off trading those markets where you can, the CME market, because you're getting a much better return on your margin, which is an important part of your trading base. So have a think about that, guys. It's an important thing. So the Goldman Sachs Commodity Index covers 24 discrete markets. We cover 10 of those markets, but we use generally different futures contracts. I've traded a lot of the other markets. Some of them are worth considering, and I wanted to bring those to your attention. Under energy, we cover crude oil and natural gas, but I found RBOB, gasoline, and heating oil to be very good trading markets. You should have a look at those if you're interested. Under industrial metals, we trade the NYMEX copper contract. Under precious metals, we trade COMEX gold and silver. Under agriculture, we trade wheat, soybeans, corn, coffee, and sugar. We're pretty well covered there. And we have no markets under livestock. And the markets in the Goldman Sachs Commodity Index in livestock are live cattle and feeder cattle and lean hogs. And I've traded all of them. Not lean hogs, but its predecessor, pork bellies. I was a big trader in pork bellies many years ago. So there's a reason why we don't cover those livestock markets. They're interesting. You should look at them yourself. Feeder cattle's been a good trading market, but general comment, I would say that markets that get the most commentary are the most choppy. There's some logic in that idea, given that day traders get excited by public comment, often masquerading as news. In fact, their trading day is lived on their idea of news. But all these markets have developed so much over the years. When I started covering sugar, it had about a $500 margin and not much comment. Now the margin's up to $1,100. There's a fair bit of comment on it. Same with Palladium, which I've suggested to a few Danielcode tutorial clients, the most recent of which is Greg Palladini, who's been talking about it here on Forum. Feeder cattle, live cattle, a bit up and down. Feeder cattle is a good trading market, but there are sometimes volume issues. And the volume jumps around very dramatically in both live cattle and feeder cattle. So just make sure that the volume, if you're looking at feeder cattle, make sure that you're checking the volume to make sure it's going to be a conveniently tradable market for you. Lean hogs is off limits due to an aversion caused by great pain. And I have to tell you the story that back in the day I was trading pork bellies, and we were long, and I had a terrific sell signal, and put my order on, and it didn't get filled because it went lock limit down. And can I tell you, it went lock limit down for 24 consecutive days. That would have been back in the 70s, I guess. But oh my goodness, the pain that inflicted. The only association I have with hogs now is occasionally Mrs. Needham allows me to eat some bacon, not often, but lean hogs is off limits. I just can't bring myself to think about trading pork bellies or its derivative lean hogs ever again. As well as which, lean hog sounds boring, doesn't it? Pork belly sounds sort of kind of sexy. And that was worth a chat at a cocktail party, so on. But there's some variations on the theme of what we do that are worth your while to consider. And we're not going to dwell on these terribly long, other than to show you this is soybeans. This has not got today's price on it. As you know, I start preparing these webinars about 3 o'clock in the morning, my time, and there's often not enough data then to update those charts. So some of them have the latest data, some of them don't. You'll just have to bear with me. But soybeans has been a consistently very good market for us. And worth your attention, particularly because of those ratios that I just showed you. Some of our clients trade some derivatives, or they're not quite derivatives, but I refer to them as that: soybean meal and soybean oil. As you can see, they're reasonably highly correlated, so you need to be aware of that. But this one isn't so much. Soybean oil is on considerably different patterns. Apart from the last little rally there. But they're good trading markets. If you're looking to expand your ideas of trading, they're market you should look at. And this, of course, is Palladium, which we've talked a bit about lately because Greg Palladini's kindly been sharing his progress through the Danielcode trading tutorial with us on Forum. And, it's you look at it, you think, what, swoopy? There's some very, very good moves there, and that's what they do. So let's not ignore the equities. I know it's important to all of you, even though it's not a feature of today's webinar, but be aware that these indices are created differently. They're constructed differently. NASDAQ is constructed on a modified capitalization method. S&P is a weighted capitalization. Dow Jones is price-weighted measurement. So the bigger companies just have so much influence to be hardly true. In fact, you can see under the S&P note there, the 9 largest companies on the list of S&P 500 companies accounted for almost 30% of market capitalization. We've known that for a long time, but you can see how the companies that are really controlling the NASDAQ, they're incredibly solid companies. I know that one of them is it's had a bad, Amazon's had a great week. Was there one that has had a bad week? Might have been Alphabet, was it? I don't know. But you can see that, it takes a fair bit to move these indices. because particularly the ones that are capital weighted. The Russell's different. The Russell, which is the small caps market, it's much easier for it to move than for the other major indices to move. So what's worrying equities? And the answer is not much. Equities have been surprisingly strong. You would have thought they would have had a freak out at today's CPI announcement. Not so. They turned down, but modestly. There's been really nothing of any real violence in the equities for a long time now. And I think the reason for that is that the bearish murmurings from the Fed are muted, and the market doesn't believe that the Fed will do anything radical. And Facebook, it was, yes, Jeff Sherburne. Jeff, thank you. I'm sorry you're no longer with us, but I'm glad you're following along at the webinars. And it was Facebook, of course. Jeff's on the ball there. Thank you for that, mate. Appreciate that. That was the one that got a caning this week. Let's have a look here. So the best guess, the market's guess, is that the Fed makes lots of noises about inflation, but minimizes actual meaningful action. And the narrative is presently based on how well big stocks have done. And of course, they've done fabulously. But so they should have, given the Fed's largesse. This has been the most friendly, what's the word I'm looking for? Climate, if you like, for stocks, for big stocks. I mean, the liquidity is at an all-time record. Nothing ever been seen like it before. Of course they should be doing well. These are very well-managed companies by and large. Some of them are extremely well-managed. They're based on great ideas, great concepts, and you expect them to do well. What will happen when interest rates start going up? I don't think it affects those biggies very much at all. And I think we need to see material change before the Feds are going to take any real action. And I know we've had Bullard today saying 50 points. I mean, so what? I don't know that's a big deal for people who trade in bonds, but to the average man on the street, 50 points is going to be maybe, I don't know, 0.75% on your mortgage. Not anything really meaningful. And I think that's the pattern you're going to see going forward, that you're going to have the Fed talking a big game but doing just as little as is possible. So let's see what happened with equities today. Not much. S&P found its perfect Danielcode target recognition at 457.850, the blue line, plus a couple of ticks, and it turned down modestly. That was all it was, a modest retracement of the minor swing. Didn't touch the major swing at all. This is the Russell. It had perfect target recognition on Wednesday at 2080.3. So today, just to show off how clever it is, it rallied up to the blue line at 2104. Turned over, said time to go back a bit, and so it did. So that high in the Russell today, incidentally, was 2103.9 against the blue line of 2104. One a tick variance. That's pretty clever stuff, isn't it? But it's modest. It's nothing to be excited about, and certainly you could only describe it as a muted reaction. This is actually a slide from our last session, and it's this idea that I've been talking about for years with talk about being a voice in the wilderness, this is from Greg Palladium, of course. It's now essential to at least hedge your retirement portfolio or possibly make trading a full-time income producer. And I want to leave that thought with you, because there's no doubt that your retirement portfolio is going to be taking a whole lot of hits in the future. and futures and Forex trading can stand as a standalone profit center. In fact, Greg from Lake of Colorado Springs, now of Texas, is with us today, and I know that he woke up to that idea some time ago. This is interest rates. This is the 30-year T-bond. Now, it's much less dynamic than the shorter-term ones, as it's supposed to be. This is the base of all government borrowing. Have a look what's happened this week. I showed you this chart on a number of occasions. It's been going for years, since about 2000, and you've seen it many times. Extraordinary how it's worked its way inside the boundaries of the Danielcode trading channel, which we stopped moving in September 2016. It's been on its own since then, and it is slavishly following the Danielcode trading channel, which is the dotted red lines, so the extensions of the solid red lines above and in the center going laterally of this chart. Have a look what's happened today. There's a Danielcode retracement. It's the 74% retracement at 150, correct 24. And that's just about exactly where the 30-year bond got to today. In fact, the low on the daily chart is 151.02. So pretty close, a matter of ticks. That's all that's in it at the moment now. Will it find support there? If the Fed's really going to talk about raising interest rates in any meaningful way, you're going to see a close below 142.18, and a close on a 24-day. These are 24-day bars. This is virtually Danielcode monthly chart, if you like. A close below 142.18 implies that the swing lows are going to go. And that's when you're going to see some real excitement and action. At the moment, all that's happening, we had a 118 cycle, a time cycle here, and we've had it on this chart for years. And this market's going down right into that exact cycle. So it'll either find support here or it'll drop to its next level of support, which is the dotted line, which is the support level from the Danielcode trading channel. Below that is the famous Danielcode black line at 142, correct 18. And if that's broken on a closing basis, it's goodbye to the lows in all probability. That sets up a very high probability trade. So keep a close eye on the T-bonds. They're the ones that have no option but to tell the truth, unlike a lot of the others. This is the daily T-bonds. As you can see, it's churning around down there. But is that a big deal? Is that exciting? Not really. There's been nothing exciting. There's no viciousness in any of these markets really at the moment, unless you're in wrong, which is virtually impossible if you're following the Danielcode signals. But there we was. US dollar index, really interesting. It's weakened off a bit, and then it's been going sideways for most of this week, doing nothing at all. So what did it do in response to today's news? Well, up and down and up and down. What's kind of interesting is that the high today at 96.01 tagged the red line at 96.005, which is one tick away, 005 from, excuse me, 010, one tick away. With all that volatility, isn't it amazing how accurately these markets track the Danielcode numbers? And if you don't have these Danielcode numbers on your charts, I don't know how you're trading. I really don't. So that's much the same. And of course, Europe, don't forget, is way behind US in interest rate hikes. US is at least talking about it. The European Central Bank is run by Madame Lagarde, Christine Lagarde, who shares something in common with Australia's ex-finance minister, who you heard me talk about on occasions. They're both fashionistas. Lagarde's an ex-French politician she was a foreign minister, and no great achievement that I'm aware of, but she's the governor or the president, actually, of the European Central Bank. And she came out earlier this week at their meeting and said, don't have any idea about inflation, no idea about interest rates, haven't got enough information. Let's wait. Let's see some more information. Let's see some more data. In other words, not a clue. But they are certainly much more relaxed about interest rates. At least in the US, it is being talked about, whereas in Europe, it's just not on the agenda. Poor Julie. Good on you. Hank, wasn't she a shocker? Oh, my goodness. Anyway, of course, the cabinet's full of them. You see what's been happening today in Australian politics. Peter Credlin, who's criticised most of them, has turned out to be a bedwetter herself. When things get tough, most of them go to water. And Peter, I'm surprised, but there you are. A bedwetter of note. Okay, let's move on. Euro. Here's the euro today. Its response, ho-hum. We'll run it up. That should be exciting. We'll run it down. That might be the right way to go. In other words, what I've just been telling you, basically, not a clue. Just ticking off its Danielcode numbers. The high today, there's this big dramatic outside bar. The high today is 1.14949. What's your Danielcode number there? 1.14946. 5 ticks. 5 ticks. Have a look at that. And the low's about the same. The low came in at 114,278 against 113,765. Not quite exact, but basically a thickness of a line all involved. No idea. Let's run it up to the Danielcode number, then let's run it down to another Danielcode number. Very relaxed. No dramas there at all. Have a look at this bar on the British pound against the yen. Same thing. British pound's not worrying about interest rates. They're worried about getting taxes up high enough that they can pay some of these horrendous bills they've incurred, and worrying about whether Boris is going to survive. He's been a very naughty boy, apparently, by doing what he's been doing all his life, having a few drinks and a laugh. But the population hate it when there's one rule for them and it's not being observed by the rulers. This is an interesting chart, this British pound Japanese yen, because the central bank in Japan came out today and said they're virtually going to buy every interest rate coupon they can find to keep interest rates way, way down, close to nothing. High of this bar today was 158.070. Have a look at the Danielcode blue lines, 158.085. 14 ticks difference. Interesting stuff, isn't it? Look where it closed. It doesn't do this randomly. The close was 157.326. Where's the blue line? 157.317, which is 9 ticks variance. Pretty perfect, all of this stuff, isn't it? Even when there's a bit of excitement and volatility around. But Forex has been fabulous lately. You Forex traders with us, you just rubbing your hands in glee and keep stashing it away. It's been marvelous. Have a look at this one. This is the dollar yen, and much the same thing here. The high came in today right at, here it is, just followed its Danielcode blue lines. Have a look at this. The high came in today at 116,337. What's the Danielcode number? 116,316, 20 ticks. A couple of handfuls, nothing. And closed, 116,028. Where's the Danielcode black line? 116,029. So this is a close below the Danielcode black line. If it gets wings and closes above the black line, that implies that the swing high is going to be taken out. These two are very close together here, but it's an interesting phenomenon that markets do this all the time. That's why it's so important to be aware where the Danielcode black lines are. Dr. Copper got very excited for most of this week, took a little sabbatical to go sideways for 5 or 6 days, and then roared up yesterday, and today obviously it's found its mark. It doesn't not quite so excited today, but look how it's just been same thing, ticking off its Danielcode numbers as it goes. Wednesday's high, I should say, was at 464.30 against the Danielcode blue line at 464.35. Today's high 470. This doesn't look right at all. Thursday. One of these is wrong. I'm not sure, and I think it's this chart is wrong. Yeah, this market's actually closed at 465.95. 1 point away from the Danielcode blue line. This was obviously earlier today, and it's rallied back up into the close. That, unfortunately, folks, is a function of the time of the day I do these things. Here's gold. It reversed. I said in sympathy with copper at the time, but, same thing, nothing much in it. Inflation should be good for gold. Didn't seem to think so today, did it? But it's still on a healthy stage. All of that's interesting background. Let's talk about something that's a big issue for you traders and all of us. Trend. Most traders, including very good traders, determining trend is the most difficult part of trading. And that's because the definition of trend is difficult. Trend is always a function of time. So we can't talk about trend unless we have a definition that includes time with trend. So there's been a lot of interest lately in 2-bar stops. You might have seen the talk about it on forum. And basically it's an attempt to avoid the one-day counter trends, which are really, really annoying. I would say that it's a pending breakdown in your personal discipline. If you've done a Danielcode tutorial, you know how to handle a one-day counter trend, and it shouldn't worry, but I know it does. And I spent years and years looking at charts, trying to think of the same thing. How do I avoid that one-day counter trend? And the problem is that exactly the same signal that gives you a one-day counter trend is exactly the same signal that will give you a complete change of trend and a massive, great big risk-off bar. So you miss trades at your peril. If you decide you're going to use a 2-bar stop, by definition, that means you stop taking every signal that comes along, particularly if you're trading Danielcode time. So this idea is just an arbitrary attempt to skip from a 1-bar stop to a 2-bar stop on the thought that 2-bar risk is manageable. But the fact that gives a 1-bar counter trend is identical, the signal gives a complete change of trend. That's the risk that you're taking when you make an arbitrary view to change how you're treating your risk. So to understand trend, the simplest way, think of a beach. Waves breaking, running back and forth, they're the obvious motion, and they're the equivalent of the daily trend, the short-term trend. Behind those waves, mountains and mountains of water are moving with the gravitational pull of the moon. And that's what gives us the tidal movement. That's how we get high tides, low tides, spring tides, and neap tides. And at the same time as waves are breaking, tidal flow is still working away remorselessly. And trend works the same way, with the smaller waves being the daily trend signals, and much bigger ones, the tides, those forces at work. So by definition, we can only talk about trend as a function of time. So if we go to a 2-bar stop, that is just a mechanical function. Why just a 2-bar stop? If we're willing to accept the additional risk that a 2-bar stop provides over a 1-bar stop, then why not have a 3-bar stop or a 4-bar stop? Okay, so it's really just adopting a mechanical choice to avoid a perceived problem. that you're looking at charts saying, I can bear a 1 bar stop, I can handle a 2 bar stop, I can't handle much more. So it's simply adopting a mechanical choice to avoid a perceived problem. But as you're solving one problem, you're creating a whole new issue around risk. And if you're trading Danielcode time, and a lot of you have done the tutorials, we never ignore a time signal. Once you go away from that, once you're prepared to ignore some time signals, you destroy your own trading system. And self-discipline is the essence of good trading. Abandon it at your peril. And it's true. You have to have a trading system. If you don't have a trading system, you're just at the whim of the market. You're just like a bit of a flotsam on the ocean being tossed here and there with the direction of the waves. You must have a trading system. Once you go away from that, I believe very sincerely that you're lost. And I say that because I've done so much in trading over 30 years or more. Any trading system you can think of, I've probably traded it. And the essence of high profit trading, which is what Danielcode time trading certainly gives you, as does the Danielcode price trading, is self-discipline. Self-discipline is sticking to the system. Okay, abandon it at your peril. But so there is a way of calculating real trend trading. This is a very advanced topic, so if you don't get it, don't knock yourself out trying to understand. I've just given you one, maybe 2 examples here, one I think, and it's a fairly tame example. And there are real trend signals in all markets, but it gives us patterns that we're not used to seeing. So to the untrained eye, it's confusing. Real trend signals can be created for any time frame. The most useful are daily signals that are fueled by momentum, but they don't have to be for a day only. They can be part of a 2-day pattern, a 3-day pattern, a 4-day pattern. But momentum is vital and inherent in trend change. A change in trend is caused by a switch in momentum, either an expansion or a contraction in momentum. And yes, real trend signals are subject to whiplash. Markets can change their mind just like you can. So they're not a panacea for everything, but they give you an idea of it, at least on a fairly simple example. This is a chart of wheat, and it's got some pinky black bands on it and some supposed to be light blue bands on it. Pete Kilman, Trade Navigator, created this for me, I don't know, maybe 20 years ago. And it's just based on a simple MACD. And it's not bad. It's not bad at all. It's a bit slow at the turns, but it's keeping you out of most of the whiplash, not all of it. The gift has to have a price, doesn't it? So this is the same chart. Okay, look at this very carefully. This has got the real trend signals on it. And there's only 2, up or down. And you can see you get a nice, lovely big run up. It avoids the 1 bar counter trends, avoids the 2 bar counter trend. In some cases, it's avoiding the 1, 2, 3, 4 bar counter trend. So this is what a real trend signal does for you. It's not dependent on a 1 or a 2 bar setup. It will work perfectly across a whole range of patterns. And you can see this one does a very, very good job. You get a big run up, decent run down, but as the market contracts on itself, you get whiplashed. And that's what happens because you need to have an expanding range for this thing to work best. And you can do that very easily if you think about it by having 2 different measures of average true range. If you see the average true range increasing or decreasing, you can do that simply by creating 2 different measures of daily average true range, and looking at the difference between them. Okay, so this is a simple way on a simple chart of looking at average true range. This is something a bit more complex. This is gold, and this is not really very complex at all, but it's the sort of thing that happens in markets. This gives you a really nice trading result, 20,000 odd in 5 months on 10 trades. What's the drawdown? Well, you stopped out, your maximum drawdown is about $3,000, but it gets a lot worse than that. And you need to have a cast iron stomach to trade these sort of signals. And you also need to have absolute discipline for the dollar value of your maximum stop. It should always be part of your trading plan. X dollars is the maximum risk I'm ever going to take. If the market gets there, I'm out, I'm flat. So it's not a panacea to ignore everything else, but it shows you what real trend trading looks like. And this is what I do most of the time. But it also leaves aside some of the very good 3-day moves, particularly what we get on the Danielcode trade signals to actually do better than this, because it is so much tighter on its risk management and its order creation than this. So I certainly recommend that to you highly, folks. Something for you to think about. Don't get totally obsessed with equities. Look at the other parts of the world out there. Have a look at some of those trades in soybeans, natural gas. They've been absolutely terrific lately. Gold's been pretty stunted, hasn't it? It's trying to work out what it's doing. That hasn't got today's bar on it yet, which was down. And I was surprised by that. It went down, did an outside bar. I suppose it finished on a positive note, didn't it? Took out the highs again. Just think about your trading. Don't be stuck in a doom loop where you're always trading only equities and usually the S&P, which is not the most user-friendly market by a long way. Have a look at the Russell if you want to trade equities. Have a look at some of the others. Go through some of the other markets I've talked to you about today. Some of them are very worthwhile, and particularly have a look at those ratios of average true range to margin. That's very, very important. You can be performing twice as well on those ones that are out of kilter in the ratios between average true range and margin, which are those 3 markets we've talked about on the ICE exchange: sugar, coffee, and the US dollar index. You can be trading twice as efficiently as other markets, and you're still not going to make the same money. And the business of trading is about the business of making money. So you need to be aware of every aspect of that. Okay, and that is about it for today, folks. If you are interested in trading, the Danielcode will certainly save you. Do take your free trial now if you haven't already. Excuse me. Poor old Terry's got COVID. He had a temperature of 103 yesterday. He's down to 101.9 today. He's still a pretty sick boy. But if you have any problems with your free trial, do contact Terry, support at thedanielcode.com. And you can certainly look for that as soon as possible. If you want to be a super trader, you want to learn all this stuff that I do on these webinars and on the website, do let me know, jneedham at thedanielcode.com with your phone number. If you'd like me to call you, I'd be happy to discuss your trading with you. And if you want to be a seriously good trader, the Danielcode tutorial is the way for you to go. Here's the link for your free trial, www.thedanielcode.com. Just hit the register button. If you already had a free trial, the website will probably remember you and may not be too happy about giving you another one, but that's because it can't count. Do contact Terry at support at thedanielcode.com if you have any prevalent problems at all with that. And remember, the business of trading futures and Forex is not to be right. The business of trading is making money. That's why we do it. And we have a pretty marvelous record of doing that. Do be aware of this disclaimer. It is very, very easy to lose money trading if you're not a competent trader. In fact, you need to be considerably more than competent to be a successful trader. But it's very easy to lose money, and it's hard to win it back once you've lost it. So do give some really serious consideration to not risking any real money until you are convinced and can demonstrate that you are a competent trader. So that's it for us today, folks. The weekend's upon us here. Murph, we need to catch up in the next week or two. I'm available. Murph, shoot me an email. Tell me when it would suit you, and I'll be happy to talk to you. Hank, enjoy your weekend, and I'm off the clock for the weekend now, folks, so do enjoy tonight's trading, or today's trading for you up in the Northern Hemisphere, and I look forward to talking to you again in a fortnight.